Hello student, welcome back to IBS. So now we will deep dive into current asset. We'll get more clarification with regard to definition. We have understood about operating cycle and 12 month or 1 year. So now he is saying whichever is longer. Operating cycle may be 30 days. In last example it was coming. Year is completed within 365 days. So it is saying current asset will be considered whichever is longer. So this is the longer. Normally that is why 12 month is considered as a current asset. Whatever the thing which remain within, which will be settled within a 12 month, will be considered as a current asset, because operating cycle may go more than 12 months, may go 36 months as I given you the example, but that will be not considered as a current asset. That will be considered based on 365 days. So that is the more better way to restrict between 1 year, because normally financial period are for 12 months. For example of current asset is cash. Cash is the current and quick current asset, like coins, currency, and deposit check. Which check you have, you need to deposit into bank, but still you are carrying it, even though you are going to give to somebody else to for payment or something, but since you have not deposited into bank, so still it is your asset. Money order and demand deposit. In other current asset are cash and cash equivalent, like short term highly liquid investment, maybe share market you have invested, or maturity, anything. For example, you have purchased a bond or any other thing for FD for 365 days or maybe for 5 years, but that is going to mature within 90 days, so that will be considered as in cash and cash equivalent, though it was classified as a long term earlier fixed asset. Okay, but long term investment related stuff, when you see it is less than 90 days, then you have to pass the entry and reclassify into your cash and cash equivalent section of your balance sheet. Then receivable is like trade receivable, not receivable, amount due from affiliate or employees. So suppose we have given advance to our employee, we will get it back from employee, so that is why that will be considered as a receivable. And for example, we sold on credit anything that we are going to be get paid within 30 days or 45 days or 90 days, so that will be your receivable whenever we are selling to any client on credit. Not receivable is similar way. So basically the person whom you have received this not receivable, they are promising to pay you after this period of time. Okay, this and that, whatever period they are telling, after that period they will pay you. So that is why this is called note receivable, or we can say promissory note or something. If you talk about inventory, when you buy an inventory is many type: finished good inventory, raw material related inventory, VIP related inventory. All these are being considered as a current asset. Okay, like work in progress, normally you might see in manufacturing or also in construction. Work in progress being considered as in construction also. When you are making a building or something, you are buying raw material and number of things, so all these things will go to your VIP and they will consider as a current asset. Like finished good, you have purchased raw material, you have processed it, you have manufactured it, now it is finished, now it is ready to sell, but since it has not been sold, so it will be remain in your inventory section. So that is why this is good for sale is nothing but a finished good. That is also your inventory. Raw material is also your inventory, and VIP is also your inventory. So normally nobody will explain it to you. Normally we are in confusion that raw material is on the inventory and good for sale is not inventory, or finished good is not for inventory. Or maybe some people think that, for example, material we have purchased to sold, that material is maybe like which is ready made, like you have purchased cloth for selling, so whatever cloth you have purchased, that is your inventory. No, if you are a manufacturing, so there may be different layers of inventory, different type of inventory: finished good, raw material, VIP. Okay, these all are your inventory, not only the finished good or the which is ready made product, or for FMCG whatever goods you have purchased that you are keeping on the store, those items are your inventory. That is good, but beyond this there is warehouse, or there is factory where all product and other things are being manufactured. So whatever the material, raw material, and your finished good or VIP, everything is your inventory. I hope it is clear to you. Okay, now we will learn about the short term investment. What is the short term investment? Marketable security is like share. These are the thing which is readily sold and converted into cash. That is why this is called short term investment. Or if you have any long term investment and that is going to be mature within 90 days, as I explained here, that is also considered as a short-term investment. Or you have purchased for 90 days or for less than 365 days, that also you can consider as a short-term investment. Suppose you have purchased a share for Google and Microsoft for less than 365 days. So you know you have purchased for less than 1 year. Whenever you need cash, you can easily sold this into market and you will get the cash instantly. So that is why that has been considered as a short-term investment. Now we'll talk about prepaid expense. Prepaid expense is very important and we need to carefully understand this. Payment made in advance, paid in advance before the service has been received. So what happened? We have sacrificed our cash. In return, we get anything? As of now, we have not got anything. So, service or asset to be used operating cycle or 1 year. The perfect example is insurance. Insurance we normally buy for 2 year, 3 year, 5 year, 1 year, but we have to pay for entire 1 year or entire 3 year. We have to pay on the spot. You will pay. So we have sacrificed our cash and in return what we get promise for insurance. As on time will pass, only then we can recognize our expense. That is called matching principle. This is what the process in everywhere it is being followed. As 1 month will go, for example, for 3 months 3600 you have paid, for 1 month cost is $100. So when you complete 1 month, when you complete 2 or 3 months, so for 3 months you will multiply by 300 you will book into your income statement revenue. In expense side you will book 300, and in balance sheet when we are paying this amount, that time we will consider in asset side 3600, and then we'll keep on removing every month 100, and it will be showing balance 35, then 34, and then 32, 33, 34, like this. Every month it will be reduced 100 and asset will be reduced and expense will be increased. What would be our entry? Expense we will debit and will credit the prepaid insurance for $100. So likewise, this will go to your income statement and this will go to your balance sheet. This is how this will work. And when we are booking this, that time what we will do, since you have cash or something, so cash will be reduced for 3600, and similar way your asset will be increased for 3600. So ultimately impact would be zero. So for what would be the entry? Prepaid asset for insurance to cash gone for 3600 and prepaid we receive for 3600. In balance sheet there is no impact, just your prepaid expense has been created. So we are going to receive benefit for longer period of time. This is also your matching principle that you need to keep in mind. Matching principle is an accrual based accountancy is required. So why we are doing this? We cannot expense more, also we cannot reduce our asset instantly without getting the benefit. As we have learned the definition, asset is something we paid or from past transaction. We are going to receive benefit consistently over the period more than 12 months. So we are going to receive benefit for this insurance more than 1 year, or if it is for 12 months, that will again in current asset, because we are going to receive benefit for future, either 12 months or more than 12 months. So we are ultimately, the point here is we are going to get benefit in future, not today. What we have sacrificed our cash now. So that is why that will be in your asset, and you will not reduce your asset and book directly all 3600 dollar into your expense. So what will happen? Your expense will be increased, your net profit will go down, which is not a good sign, or which is not the correct, because we have not received. For expense, the definition is we have consumed the benefit or we have received the services. Since we have not received or consumed anything, we are going to receive the benefit, so you cannot book the expense. So that is why this will remain in asset, and every month when you complete the period, then only you can book into the expense. I hope it is clear to you. If not, you can rewatch it. I think we are done for the day. We'll see you into the next session. Stay tuned. Thank you very much.